With all that's been going on in our world, our center of gravity appears to be shifting on the daily. Hundreds of cities across the U.S. are protesting racial injustice, with a number of them promising to defund entire police departments. This has led to mandatory curfews, the activation of the National Guard, and as if things aren't challenging enough, signs of growth in our pandemic curve again. In addition, earlier this week, it was announced that the U.S. had officially entered into a recession in February. Despite all of this, the stock markets continue to soar as if none of this is taking place. So how's the housing market doing? I'm Chris Cornish, and this is your Midweek Market Watch. Let's take a closer look. The long and short of it is that interest rates are crazy low, housing prices are up, and they're only expected to keep growing. You might be wondering how this makes sense. If we're in a recession as well as a pandemic, unemployment is at record high, earnings are down, and so on, how will house prices not suffer? More curious still, who will be the people keeping the demand high? In fact, there are a few more reasons to wonder about this. Mortgage delinquencies and forbearances are through the roof right now. In February, 450,000 households were in forbearance, but by March, those numbers jumped to 1.9 million. What's more, between February and April, delinquencies fell by close to 65%, suggesting that homeowners who were already defaulting on their mortgage before COVID-19 hit are likely taking advantage of forbearance opportunities. Those hardest affected appear to be properties worth less than $100,000, those with loan-to-value ratios at 90% or higher, and loans serviced by Ginnie Mae, particularly FHA and VA loans. However, two factors make our growth predictions what they are. The first is inflation. With all the money the Fed has been funneling into our economy, we're expecting inflation to outpace earning growth several times over. Earnings are expected to grow at a rate of 2%, which is actually up from April's estimate of 1.8%, while inflation is expected to push food and gas prices up between 7.8 and 8.7%. This is not good for our economy overall, but it is good for homeowners who buy in before the hikes fully take place. Basically, it means that if you buy a property for, say, $100,000, that property could be worth $120,000 before the end of the year. If you're able to put down just 20% on that property, you'd be doubling your money. The second factor is, of course, the extremely attractive interest rates. Typically, real estate investors account for 1 in 10 transactions across the country, and these crazy times have not changed that. In fact, as fewer and fewer households are able to qualify for a mortgage, rental properties have steadily increased in demand, which has created even more incentive for investors to buy. Add into this mix the fact that we can anticipate more supply as a result of the rise in delinquencies, and you get why investors are seizing the opportunities. So yeah, real estate is still expected to keep growing in the immediate term, though only investors and higher earners are likely to be able to get in on it. That's it for this week. If you found this content helpful, sign up for a Midweek Market Watch in the footer of our website, where we release a free housing report once a week. Thanks for tuning in.